Hi, welcome back to Fi News, and before we dive into today's topic, don't forget to subscribe to our channel for latest in finance, tech, AI, crypto, and global affairs.
If you've spent any time online lately, you can feel it, right? Things are looking pretty grim out there. Bitcoin's down, altcoins are getting absolutely hammered, and the chatter is getting louder and louder. Is this bull cycle over? So let's just get right into it and tackle the one question on everybody's mind. I mean, if we really are heading into a full-blown bear market, we have to ask the tough questions. It's worth taking a serious look at where the actual floor might be. So in this explainer, we're going to break down 3 potential scenarios for you. Everything from a business-as-usual historical correction all the way to a complete doomsday crash. And that quote? It pretty much nails the vibe right now, doesn't it? That feeling of anxiety and uncertainty is exactly why it's so important to just step back from the noise, look at the actual data, and try to understand what could realistically happen next. All right, let's kick things off with our first scenario. We'll call this one the baseline case. It's built on a simple assumption that this time isn't different, and that history is probably our best guide for what's coming. Look, this pattern is nothing new in crypto. It's not a bug, it's kind of a feature. If you zoom out on Bitcoin's entire history, you see it over and over again. These massive, euphoric runs up, followed by equally brutal drawdowns. In fact, just since 2014, Bitcoin has had 4 separate drops of over 50%. For crypto, these drops are just part of the seasons changing. Okay, so for the sake of our little thought experiment here, let's just pick a number. Let's imagine a hypothetical cycle peak of $126,000 hit sometime in late 2025. This just gives us a solid starting point to calculate where a potential bottom might be. Now, this is the number you really need to pay attention to. In the biggest bear markets of the past, we saw drops of nearly 80%. Even the most recent one back in 2022 was about 75%. So a 70 to 80% fall from the peak, it's not some wild fantasy. Historically, it's been the baseline. So you take that historical 75% drawdown, you apply it to our hypothetical peak of $126K, and where do you land? Right around the $30,000 mark. And this number isn't just pulled out of thin air. It also happens to line up with the major area of price action from the last 2 cycles. And this quote, man, it just perfectly captures the feeling of a real market bottom. A drop to $30,000 would cause what they call maximum regret. The people who bought late would be devastated. The people who bought early would be kicking themselves for not selling higher. It's a price that's basically designed to shake almost everyone out of the market. But here's the thing. The pain isn't just about the price dropping. It's also about time. Bear markets aren't some quick rip the Band-Aid off crash. No, they are a long, slow, soul-crushing grind. Historically, that journey from the peak all the way down to the trough lasts about 12 to 15 months. That would put a potential bottom for this cycle somewhere in late 2026 or even early 2027. Okay, so that's the historical case. But what if history isn't a perfect guide? There's a real argument to be made that the market has grown up and that this time really is different. And that brings us to scenario number 2, the case for a much softer landing. So why would the landing be softer this time? Well, there are a few huge new factors at play. For one, you've got the spot ETFs. They've brought in billions of dollars of what you might call slower money, institutions that don't just panic sell at the first sign of trouble. You've also got these huge corporate whales who are more likely to buy the dip than to cause it. Throw in a much more mature derivatives market to absorb some of the shocks, and the fact that the last top was a bit less crazy than previous ones, and you've got a pretty good recipe for a less severe drop. So when you factor in all of these new structural changes, the potential floor starts to look very different. Instead of a brutal crash all the way down to $30K, this scenario suggests more of a slide into that $50,000 to $60,000 range. Now that's still a big drop, don't get me wrong, but it's a far cry from a full 75% collapse. All right, we've covered the historical case and the optimistic case. Now we have to look at the other side of the coin. Because while there are reasons for optimism, there are also some serious storm clouds on the horizon that could make the next bear market worse than usual. This is our doomsday scenario. So what could trigger this? Well, imagine a perfect storm. It starts with a major macro shock, like a global recession. At the same time, maybe the AI stock bubble finally pops, forcing big funds to sell their most liquid assets, like Bitcoin, to cover losses. And internally, you could have leveraged crypto companies being forced to liquidate their holdings. And remember those ETFs that were so helpful on the way up? Well, in a real panic, they could become an incredibly efficient way to dump billions of dollars onto the market fast. In that kind of nightmare scenario, we wouldn't just be testing that historical $30,000 floor. We could blow right past it, sending a terrifying wick all the way down into the $20,000. It's definitely a low probability event, but it's not a zero probability event. You can't completely ignore it.
Okay, we've been talking a lot about Bitcoin, but what does all of this mean for everything else, for the altcoins? Well, as you can probably guess, if Bitcoin catches a cold, altcoins tend to get pneumonia.
Yeah, this table pretty much says it all, doesn't it? While Bitcoin historically drops around 75%, the major altcoins get hit so much harder. We're not just talking a little more. We're talking 95% for Ethereum, 97% for Solana, and over 90% for others in past cycles. It's a total wipeout for many. The only real exception has been BNB, which tends to stick a bit closer to Bitcoin.
And this quote right here just drives the point home perfectly. As amazing as the ride-up can be on altcoins, you have to remember that the ride down is almost always much, much harder and faster than it is for Bitcoin.
So after exploring three very different, very possible scenarios, what's the ultimate takeaway? What are you supposed to do with all this? Well, the goal isn't to perfectly predict the bottom. The goal is to prepare for a range of possibilities. Here's the most crucial point. The exact number, whether the bottom is 55K, 30K, or even lower, that matters less than having a plan that lets you survive and maybe even take advantage of whatever scenario actually plays out. So what does that preparation actually look like? Well, it's pretty simple, really. First, you just have to accept that a 70 to 80% drop is historically normal for this asset class. Second, you need to understand this is a long game. We're talking 12 to 15 months of pain, not a few bad weeks. And third, you use that knowledge to size your positions the right way, especially with those super high-risk altcoins. And that, right there, is what this all boils down to. Risk management. It's not about being a genius who perfectly calls the bottom. It's about structuring your portfolio so that even the ugliest, worst-case scenario is survivable. It's something you can live through, not something that wipes you out of the game for good.
So I'll just leave you with this final thought. As you look at these potential futures, the historical blueprint, the softer landing, and the doomsday crash, which one seems most plausible to you? And maybe the more important question is, when you look at your own portfolio, is it prepared to withstand all three?